Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Monday, March 2nd, 2026. It is 10:16 a.m. Eastern Time as I'm starting the video. I'll try to keep it quick. I just wanted to get my thoughts out early on this. And one of those thoughts are this is, I think, this pre-market or post-market recovery bounce or any bounce today should be viewed as an objecting short inch add-on. I'm trying to toggle over. Let me get to the 60-minute charts. But what I'm noticing, and it is laughable, is the Pavlovian conditioning, the classical conditioning of the just not just retail institutional investors in recent years to buy a dip on just about anything. Any bad news is amazing. So and look, that works when the technicals are solid and you're in an uptrend. Bad news can get shrugged off, and it's a buying opportunity to buy pullbacks. Here's the thing: I struggle to see in any way, shape, or form how the pretty much the war or attack on Iran, however you want to call it, can be spun as anything but net bearish for the stock market. Political instability, no really plan in place, and again, I welcome comments, I welcome feedback. But again, and I know it wasn't a surprise. Obviously, it was very well telegraphed. The U.S. was moving, pretty much the whole, all branches of armed forces over there, Navy and, the Air Force jets and bombers moving over into the Middle East. So the attack itself wasn't a big shock to anybody, a surprise. But let me just tell you the facts here, okay? So you guys, again, whatever, if you have some thoughts on that, that's not my area of expertise, geopolitical instability or anything there. But what I can tell you factually is this is USO. And this is it's the ETN. It does as good a job as any. You can also look at crude futures. But a couple years back, I created these zones for you. I first created them back in, early March, so 2 years ago, March of 2024. And I gave you yellow, orange, and red zones, and with the prediction of what it would do to the market. So for those of you not familiar, of all things out there, crude is the most direct and immediate, has the most direct and immediate impact on the consumer, on the economy, because as much as we're trying to get away from fossil fuels, we're not even remotely close to there yet. So when gasoline prices go up, energy prices as a whole, that means your electric bill, your heating bill, manufacturing, just about everything made, any product. A lot of them are petroleum based. There's energy used to make it. And again, there's an immediate impact when prices go up at the pump, right? Because most of us have to commute some form or another. So I gave you these zones way back then. If I turn off the lines, you're not going to see the zones. So I'm just going to toggle over the S&P 500 in white. And so, is that they were color coded appropriate. Yellow just means kind of elevated energy prices, crude prices. Orange zone, as the name implies, gets a little more dangerous. In the red zone, we've only kissed the red zone 1, 2, 3, 4, 5, and now we're clearly into it. So, oh wait, there's one there, and you can look and see. I'm just gonna have to change my arrow color tool. We hit it there, and as we were going up, we were back into the yellow zone here first. It started to put pressure on the stock market, and this is when we were even more hypersensitive than now on inflation. The market, it was, because we were just coming off that runaway rampant inflation in the Biden era, and the Fed completely missing it, being dismissive of it. You all know what happened back then. And so the markets were a little more hypersensitive, and they pulled that George Bush mission accomplished kind of thing, if you remember that, on the battleship or the aircraft carrier when he declared mission accomplished over there in the Middle East, and that proved to be a big mistake. And I think the markets have done that with inflation. That's my opinion, and I could sit here and make the case. Maybe I'll do that in this video or maybe the next one. Either way, I can tell you these periods, you can see there hasn't been many. It's been a strong bull run since the market troughed, back in 2022. But the corrections, hopefully you can see the white line. That's where I overlaid, and I'm drawing the arrows. If you can't see it, this is the S&P. Every single decent correction since then has followed or coincided with tags of the red zone, except right here. This is where we we also had a big drop. That was the early 2025 drop there. So there was kind of a reset. And I always say that with kind of sell indicators, sentiment indicators, things like that. When you have a big drop, that was the biggest drop right there. You kind of get a reset. And it also kind of dovetails into what I was saying about the whole mission accomplished thing, where they believe that the Fed and I think most market participants believe we dodged that bullet, and inflation's a thing in the past. And I think it's just the next leg up is to come. Probably stagflation is what my overall expectation for the coming years. Not just 6 months. I'm talking years out. Either way, what I can tell you is, remember, this is the S&P right here, punching up to all-time highs recently, and the green, hopefully you can see it, a big gap up. Crude prices are up about 7% today, and well into for the first time, well into my red zone. And so that's that. You guys could take it, do what you want with it. I just would argue, try to find a seasoned analyst, anybody familiar with the financial markets that can spin high, especially multi-month or even multi-year gas prices and energy prices, crude prices is anything but bearish for the economy. So that's kind of a hard stop. I'll move on. Let me just turn off my comparison tool, and I'll just show you, my one of many of my kind of inflation measures. I've used this one in the past. DJP, there's a lot of broad-based commodity ETFs and ETNs out there, and this one tracks. It's the most common one, the Dow Jones UBS Commodity Index, and I even noticed, I didn't comment on it, guys, when they cheered the market cheered the January CPI data, and they cited falling gas prices. I swear to God, that was one of the biggest things I read over and over. It's falling gas prices in January. Well, guess what? There is a gas ETN out there. It tracks, gasoline futures. All these ETNs, whether it's USO, UGA, which we're looking at here, they, all they're doing is they're investing in the futures. I like to go with the futures directly, but I show these charts. They're easy to see. And this was, by the way, so this was January right here. And I laugh because I don't know where they got that number from. There's been a lot of criticism about the government's, method of measuring inflation, but it was a straight right up. Again, you're looking at the chart here, looking at the beginning of January right here, and it was nothing but full throttle up, and it has been, and now look where we're at. So again, the takeaway, guys, is the market's gapped down pretty good this morning. I'm sure there were some of you that maybe wished you'd gone home short over the weekend. But my point is, I think any bounce, including this one, we've already recovered right now. My two favorites are QQQ and RTY. Those are the ones we're officially short. It's been a 1.35%, almost 1.4% recovery off the gap down this morning. And this is just a 1 minute chart here, so I could show it to you real close, but you can see there's, confluence. This is where we traded for the that was all last week on Friday. A lot of resistance there, and that's it. So I just wanted to say, fundamentally, again, they're buying the dip because they are, market participants have become that. It's not my thing. I've read about it. I know it. And people have just completely bought into that buy the dip mentality because it's worked so long for so well. And it's going to take, where Pavlov used classical conditioning, ring the bell, feed the dogs, and then ring the bell. Dogs would salivate thinking the food's coming. There wasn't. And then B.F. Skinner's the other one I like. He used that negative reinforcement, where the rat had to get a treat, and if he hit the wrong button, the rat would get shocked. And that's that negative reinforcement that Skinner was famous for in his studies. And so it's going to take quite a few of those shocks. In other words, these dip buyers to buy these dips, and then the dips get faded. So basically, I'll keep it super simple. I've been saying this forever and a day. Unless we clearly take out, I've been saying it since October 10th. That's how long. We need to clearly, in S&P and QQQ, clearly take out those October 10th lows. They since became the bottom of that trading range, multi-month trading range I've been talking about. And you have the 200s just below. So that will be that first WTF moment, or what I call point of recognition, where these dip buyers realize, ruh-roh, something's wrong. I keep buying the dips, and it's not working like it used to. That's what Kramer told me to do, all along, buy the dips, or whoever your favorite analyst or TV personality is. And so, they've been buying, and they're not really underwater, relatively speaking, but they're not making any money anymore. It's not working. It hasn't really stopped working either, if you say it again, but it will once you go under there. So you guys know my thoughts. I still expect a downside break. I still expect a very swift move down to at least T2 once that breaks. And that's it. So I just wanted to say that this dip buying is just conditioned behavior. That's all it is. And again, there's, even though the attack on Iran was not completely unexpected, we may or may not have done it. It's not, but again, and especially the way things have gone, and what I'm hearing, kind of lack of a true plan in place going forward. And mainly oil prices. Let's just leave it there, guys. If I'm sure, I wouldn't be surprised. I haven't read the headlines. Maybe it's already happened. Trump may release the SPR, or is it Strategic Petroleum Reserves. Do something. I know that they'll try to probably get oil down, especially if it holds up here. But either way, guys, we're positioned for it. Look, we shorted airlines, not based on, it wasn't my expectation that Israel and the U.S. would invade or attack Iran. It was based on the charts, and the charts are a very, very accurate predictor of the future, and it prices in all known and potential variables. And again, it was a clear shot, and so I got that out to you today. We had our first target in Delta. Somebody asked me in pre-market, it was actually a little better than the whatever it came, because we were down below there. I told you could basket short them all. I just gave you picked a handful for official trades. And Delta, by the way, it wasn't just T1. It was also the 200-day exponential moving average. And again, this is where Pavlov's dogs buy. The dip buyers step in. You see that red line, 2, 3, 4. And so likely reaction. However, I fully maintain these additional targets. And so reaction or no reaction, especially, here's the thing, guys. Me personally, I'm not normally I love to game those bounces. You know me, but I also tell you when I think there's a good chance of a bounce and when I think there may not be. In this case, I don't think it's worth it. Any bounce back up to about right here, sure, is objective. There's a gap there. You have a previous reaction. So if we get a little bounce, absolutely an objective re-enter add-on. But with oil, as I just showed you, breaking out to now multi-month highs, unless that gets hard reversed and oil really starts to plunge, this is going to hurt the airlines. Yes, I am aware airlines hedge. Some hedge more so than others. Some kind of use it. They use more aggressive hedging, which can backfire. In other words, trying to game when oil may go up and not, and you go heavier in the futures. And others kind of use a more moderate, I forget offhand which one, some of the big airlines. But again, you can hedge all you want, but a big move, I'm sure most aren't fully hedged. And they only hedge to an extent because hedging is expensive. It's a cost. So again, let's keep it very simple, guys. Yes, airlines do partially hedge fuel prices. It's their second largest expense behind labor, but it's not fully hedged, and so there's no way to spin that as bullish. So the fact what just happened when we shorted them back here, I didn't know, and nor did anybody know, and probably not even Trump himself, whether they were going to invade or attack. Oh, sorry, Iran, not invade, attack. All right, so that's it, and so that's still the second official target, and I'll likely extend these targets here. There's UAL, broke down today, hit the 200s. LUV, this was also an official trade idea. Obviously, lower stops now. You hit for T1. There's no reason to let a winning trade, profitable trade, go to a losing trade. I gave you this one too. RYAA, Ryanair. They're kind of like the JetBlue of Europe, from what I gather. Anyway, you guys know the trade ideas. There's Alaska Air at that first target I gave you, 1213 in the recent video. No, that's American. I'm sorry, American Airlines, AAL. Alaska at support right now, SkyWest. Let's move on. And then let's not forget, the Carnival, like I said, it started last week. It's taken a while, but again, it's one of those trades. We pretty quickly hit my first target zone right here, and I gave you a total of 6 targets. I gave you initially 5, and I added another one. Fully maintained this, all looking better today. Remember, a week ago it was or a couple weeks ago, the Mexico taking out the drug kingpin. And I was stating how Mexico has become, and it's not just my opinion, I've read about it. I used to go years back, and I have no desire to go now because the former quote unquote safe places, Cabo, the Yucatan Peninsula, Cozumel, Playa del Carmen, all those, and now we saw Puerto Vallarta. These things are no longer safe for Americans. And so Carnival has a huge exposure to cruises in Mexico. And now, guess what, guys? Fuel prices have gone up. Those ships don't run. There's not a bunch of giant sails and masts up there using wind power to get around. These guys burn a lot of diesel to run that big giant city on the water, and whatever. Take it for what it's worth. But technically, doesn't matter. We broke down. I've been highlighting this one as a new objective short entry on that minor trend line break, and now we have a new breakdown of this uptrend line here, and all we have to do now is take out the 200-day moving averages. Remember, they will buy pullbacks to the 200 once you're above it. Once you lose the 200s, it's bearish. All right, and that's it. So I still fully maintain those targets, and looking better today with oil doing what it's doing. That's kind of the gist of why I want to get this video out to you guys. Financials, everything that I've been patiently waiting for and talking about day after day for weeks and even months now is slowly developing. There's still some, okay, I had to pause the video there for a while. I had to take an important phone call. All right, so let's move on where I think I was at, or I believe I was on XLF. Check so far. Just waiting for those recent lows to go. That's a big one I'm watching. And again, this is where, in my opinion, unless tech completely takes the baton back, I'm talking the Mag 8 stocks, and money starts, and it wouldn't surprise me because it's been a market of rotation that would, tech has a bigger weighting, twice the weighting of financials, but they are the second largest. And there's also that importance to the economy. And so, I've been theorizing or, putting out there that, the next shoe to drop, or a shoe that could bring down this super bulletproof Teflon bull market, would be a credit event. And so I continue to watch the business development companies closely. They're still below that key low from back in 2022. Still below. They're up a little today, but that means nothing. They've taken support. Unless they get back above 13, again, they have a bullish technical posture with divergences, but I always say often that divergences are not buy signals, they're conditions. And in a bear market, especially once it starts to really get going, divergences, positive divergences get burned through. Just like in a bull market, negative divergences will get burned through or play out for just minor bounces. So right now, I can tell you definitively, from my in my humble opinion, this is the business development companies are in a very precarious technical posture, and there's still the potential for contagion from this sector, credit risk, to spill over into the other rest of the financial sector, including but not limited to the regional and bigger banks and other financial related companies. On that, on a very closely related note, is private equity. Again, a lot of the same companies have their hand in both cookie jars, private credit and private equity. And, the charts, really are the guide. I don't predict things with a crystal ball. I'm not sitting there and looking in a crystal ball and trying to, predict some kind of credit risk or problems in the financial sector. The charts are telling me what's going to happen. The news, I've done this long enough and I've said it often to tell you the news will follow. The headlines will follow the technicals. If I'm right, and private equity has peaked. So far, it's put a triple top in and it's been moving lower. There's still a major reaction low. That's comparable to that big low that private credit just took out. So, and look, potential, if it can rally here by the skin of its teeth, it's holding on to some divergences. It's at support. It's a minor support, not a great support. But when I look at it longer term, we're on this uptrend line right here. This is my weekly chart. Here's the COVID lows. Nice, clean, beautiful trend line, right? Nice, clean reactions off this trend line. 1, 2, 3, 4, and now 5. We're here. That was a divergent high right here. That gave us all this. This is a weekly chart. This was a divergent high. So far, it's given us this. If this trend line breaks, I believe we'll get that. All right, that was a divergent high there. It gave us all, well, there was the first leg down. Back test, almost to the, not a back test, it was a slightly lower high. Again, this is how things, you just have to have patience in the market. And so far, things are playing out as the technicals, are indicating. We're at support. And as I like to say and often do, support is support until unless broken. So, so far today, they're buying the market, they're buying private equity, buying a lot of things because they hit support. The $1 million question is, are those speed bumps on the way down to a bigger drop, or is it just a correction in an ongoing bull market? So far, again, depending on what we're looking at, some things look more bearish than others. So let's see if I have anything else for you. That's pretty much it. I haven't given you a lot of updates on gold and silver because they've been doing what I expected. I remember before the big drop and right after, I showed you how after a parabolic trend breaks, like it did in silver, there's that period, usually lasts at least a few weeks of consolidation and pretty big price swings. But there's what I gave you this morning, both futures and this is SIL, the ETF. You've got a nice little uptrend line, negative divergence. Here's the bounce target zone I gave you after the big drop. Bounce target where I figured silver, and that's what I'm focused on, would come into. I also predicted then that based on the gold to silver ratio and historical similar moves after parabolic breaks, that gold would likely outperform silver, and it has on a relative basis, relative to the percentage. For example, the fibs here. Let me move this fib, my Fibonacci line. Here's the drop. This is the fib that measures this line here from the very highs right here to the recent lows. 1, 2. It's really a triple bottom low so far. And you can see we're right up, stop just shy of the 50% Fibonacci retracement on silver. Gold has been a lot stronger. This is the right here. I have the same fibs measured from the high right here. That's the top of the fib line down to the low. That's where these fibs come in. And we're already up to, again, as expected, a stronger retracement. A little above my bounce target zone, but it's silver where my focus is in this trading. And right now, I just turned back on the 78.6 fib, and we're at that right now on gold. And you also have a bearish rising wedge pattern on this 60-minute chart, complete with the negative divergence I'd like to see. So, yes, so gold will, it's objective short here. Some traders use Fibonacci levels exclusively. I like to incorporate them in. There's not a whole lot of price resistance, although there was some consolidation previous around that level, but we're at that 78.6 fib. You could take a shot at gold there. But again, I like silver, more meat on the bone on silver. I think a good pair trade is gold, long gold, short silver if you're bullish the metals. And if you do that, you need to overweight gold a little bit. You have to adjust your position sizing because silver moves more in dollar percentage terms, right? So probably about I don't know, maybe a 30% overweight in gold. So round number, you short 100 or go long 130,000 gold, and then short 100,000 or 90,000 silver, something like that. But again, I think they're both poised to correct now, most likely. And if I'm right, we'll get that, if the markets do take out, going back to the QQQ and SPY, let's start where I started the video and we'll wrap up here. If we do go and break down, as I expect, the 589 level on QQQ in the 200 days, and we drop down to T2, which I think is only the start of a bigger drop. And then SPY also needs to take out, as I've been telling you, the midpoint in the trading range, which would take it down to the bottom of the trading range and its 200 days. And if that happens, remember, I'm talking about the big credit unwind. I don't have that chart queued up, but I showed it to you many times before. The FINRA margin debt bubble and how that's gone parabolic and very indicative of a top. And I say this for those of you that I'm trying to hold my words. I don't want to be offensive, but I'm going to say drinking the Kool-Aid or listening to the vast, not all of them I know, but the vast majority of analysts that are very, or at least bullish or not calling for anything bad. They might not be calling for a 20% run in the S&P this year. I think even a lot of the bullish analysts are a little tempered, but still calling for an up year, maybe a slight down, little correction sometime this year, followed by another leg up. Those kind of folks that just don't see a much bigger drop. The simple reality is the market will ultimately collapse on its own weight, and then selling begets more selling. And again, it's a historical. I've showed it in the past when margin debt goes parabolic, and then that unwind starts. It's simply a vicious cycle. Selling begets more selling as forced margin call selling hits. And that's what could take gold and silver down as well with it, because those same folks that have been loading in silver and gold probably have a lot of NVIDIA and the likes as well in there. So, all right, guys, that's it. I'm going to kept this one relatively short. Let's wrap up here. And I'll be eager to see how the week finishes. But like I said, at this point in time, I think it can't get crazy short. It's still not that all-in moment until we take out those levels. The 673-ish level, the midpoint on SPY, and then the bottom of the range on QQQ in the 200s. And then if and when SPY loses the bottom of that trading range, that's going to be a much more powerful sell signal. It'll be the first time since right here we lost the 200s. We got that. We lost the 200s back here. We got that. And sooner or later, whether it's days, weeks, or many months from now, we'll lose the 200s again, and we'll have another nice, at minimum, another nice correction, and quite possibly the start of a new bear market. We'll see. But guess what, guys? Until then, this isn't my only trade. It shouldn't be your only trade, the indexes, that is. It continues to be a stock picker's market, and I just can't reiterate that enough. We're having a field day. The success rate on the trades, the profitability on the trades are just blowing away the stock market. The stock market's doing this, ping-ponging around like in a regular EKG. So all you got to do is be long the most bullish sectors, short the most bearish sectors or stocks right now, and it's actually pretty damn easy, in my opinion, right now. The charts are just, technicals are working great. Look for good quality beat down stocks that support with positive divergence and oversold conditions and sector rotation, and make sure you're confirming the sector is bullish or bearish that you're going to engage, and then that's it. And then at some point we'll get I think the next big move to be heavy in the markets will be a drop, is my opinion, because if they broke to the upside anytime soon, I told you I'm not chasing that breakout. It's one I think will fail. But with that being said, once the markets, if we do break support, we get a broad-based sell-off. That's what tends to happen. And then what I do personally, then it's easier to shift heavy into the indexes, short futures, small caps, large caps, whatever you want to trade, and because the market starts to move fast, and then it gets a little more difficult for me to manage a position of 20 individual stocks and sector ETFs and things like that, and other commodities. So that's what I keep talking about, that all-in moment, and that comes again when QQQ takes out the bottom of the trading range there, and then it should be a pretty quick swoon down. Same thing with IWM, small caps, and SPY as well, because remember, SPY should start to catch up a little bit because the financials have they're closer to all-time highs, while Mag 8's been correcting for a while. So yeah, you still probably get more downside in QQQ, but the S&P, if the financials really take it, especially if there's a credit event, that's why I'm watching private equity and private credit so closely, and the regional banks and the other subsectors, insurance, everything else. That's where you can see, just like you did in the financial crisis, that's where throughout that bear market was one of the first in history where the S&P fell about the same amount as the NASDAQ 100. But normally in a correction or a bear market, the NASDAQ 100 will outperform. Both in bull and bear markets, it'll outperform to the upside or downside. Okay, let's wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.